Have you ever found yourself in a trade like this, where it works out just fine, but you get stopped out before the trade makes its big run, causing you to lose instead of win, even when you were right about the direction? This is what we call a stop hunt, but there is a way to take advantage of stop hunts, so instead of losing, you can actually use them to get pinpoint entries. And that's what I'm going to teach you in this video, so let's get to it. I want to start by prefacing why this happens. So when you actually get stopped out on a position like this, what we call a stop hunt, it's not a malicious attack on your stop, okay? Now, a lot of traders have it in their mind, it's bank manipulation and they are trying to stop you out. This is not really the case. All that's happening here is the market is reaching for and trading from points of liquidity. Now, liquidity refers to orders. So money or transactions in the market. The market flows because of transactions taking place. So the market flows because of different buying and selling orders that are situated at different areas in the market. Now, when we look at a price movement, just like the one we're monitoring here, we have the high of the price move, and then we have the range, and we have the low of the price move down here. Now, where are the orders taking place when you think about where people are buying and selling and placing their stops? Well, generally, people are selling from underneath the highs, okay? So sellers may enter the market somewhere in this area. Or they may be buying just above the lows, so they'd be entering the market at this area. Now, this leaves a kind of gray area in the middle just here, where a lot of transactions aren't really taking place. This is why the market is able to continually push from highs to lows, and then two highs and then two lows, okay? The reason that the market is able to make these broad movements from high to low, where we have the large moves taking place in the middle, is because there's not a massive amount of transactions in the middle of a trading range. The transactions, the orders, they're at the highs and they're at the lows. Now let me explain where the orders are, what the orders are. So we know that the majority of buying and selling transactions are taking place, sells towards highs, buys towards lows. Now sellers at the highs are obviously usually going to be placing stop losses. If sellers up here are placing stops, where are they going to put them? Well, the general education suggests in the market, and it does work, it's right, is that your stop loss should be above the high. Now, this is generally probably what you're doing as well when you're making these trades and taking losses where you're getting stop hunted, okay? Now, this is generally probably the rule that you're following as well when you're taking these trades that get stop hunted. Your stop loss is above the high, and then the market comes back, pushes over the high, and you get stopped out. Now, these stop losses up here are orders, right? They are basically a buy order to buy back contracts at a loss. So if you entered short on a sell here, your stop loss is basically a buy that will buy back the contracts that you sold in advance at a higher price than you sold them for, meaning you're going to have to pay that difference. That's where your loss comes from. The same goes for the buy side. If you buy above the high, so let's say you put a buy order in here and you have your stop loss underneath the previous low, so somewhere like this stop loss is a sell order to sell your contract at a loss. You sell them for less than you bought them for, so you take a loss, right? It's important that you remember that these stop losses are orders. They are sell orders and buy orders in the same way that the actual entries for the trades are, right? It's not some magical thing that gets you out of a trade. It's literally just an order saying, okay, take me out, sell this back to the market, or buy these contracts back if the market gets to this level so that I don't take a bigger loss. Now, because of this, all of the sellers that sell within this range here are going to have stop losses above the high just here, right? So we have selling taking place, we have stop losses taking place. That means if we have a seller at the exact high, a seller a bit lower down, seller a bit lower down, and so on and so on and so on throughout this range, even if it's thousands of sellers, they kind of have staggered orders at different levels here. But the stop losses are all going to be collected in this point. And it's not just retail traders here. This is sometimes commercial banks as well. So smaller banks and maybe even sometimes larger banks who are executing positions. Obviously, banks trade in a considerably different way. Bank traders are not sitting and looking at charts like this. They're using different algorithms and machine structures basically to take their positions for them, but they still are going to operate a lot of the time with stop losses and an understanding they're going to have to get out of the market if markets reach to one area. So on the flip side, the buyers buying down here, they may buy at different levels, but their stop losses are all going to be in a predictable location, which is underneath the low. So somewhere down here, right underneath this previous low. Now these stop losses, once again, collect in a big pool of orders. There's a massive collection of sell orders here and a massive collection of buy orders in the high. Now we have another thing. So the first thing to note is stop losses. They are part of the liquidity, but we also have stop orders. So we are looking here at buy stops and sell stops. So a sell stop is an order that will trigger you into a short position if a level breaks or if a certain price level is reached. So a lot of traders, breakout traders specifically, are looking to sell once this low breaks. So when this low breaks here, there will be sell stop orders triggered to hopefully trade a break retest and continue the market lower. There is the opposite on the top, above the high. We have buy stops of traders expecting if the high breaks, it's likely the market will continue, okay? Because obviously, at that point, we've broken above a support or resistance level as a lot of traders see it. So they'd be looking for a continuation higher and the buy stop would trigger them into a buy. So we have a massive amount of buy orders in stop losses and also a massive amount of buy orders in buy stops. Down here, we have a massive amount of orders in sell stops and sell orders from stop losses. So there's massive sell liquidity down there, massive buy liquidity up there. Now, markets react to orders, as we've said, right? If there's a massive area where transactions are taking place, such as up here or down here, this is going to provide liquidity to the market, which basically means there is a massive amount of selling that you can take advantage of. If you're a buyer, you can buy the contracts that are being sold here. If you're a seller, you can sell the contracts that are being bought up here, right? You have someone on the other side of your trade to take a position. So when we talk about institutional participants who are trying to take trades with massive amounts of money, it's these areas here of liquidity where they're actually able to execute these massive positions because there's massive amounts of selling taking place or buying taking place, which means they can take the conflicting side of that trade. And that is why generally when we see these highs and lows swept, we get such powerful movements. Now think about that in the case of this trade where we've been stop hunted. The high's been taken, all that liquidity's been opened. Now the institutional participants can get their large sell orders on, which is what causes these movements here, these massive dramatic movements, right? These big pushes in the market that we see. This is the institutional participants forming these moves, not retail. We are not important enough to make considerable movements in a market like this. So the reason these stop hunts take place is a bit more clear to you now. It's just a matter of liquidity. It's a matter of large orders being taken from certain participants and a massive collection of orders being taken from smaller participants like retail traders and smaller commercial banks. Now, the first and most simple way to avoid being caught in this liquidity is to avoid equal highs and equal lows in a market. So what we can see in this example is a range in a market with a collection of equal highs, which we could see as a resistance, and a collection of equal lows, which could be seen as a support floor. Now, these are super obvious levels traded by a massive amount of traders, okay? Which means that support and resistance becomes a very clear hotspot for liquidity, basically. If we see a resistance level, there is a massive amount of liquidity above. If we see a support, there's a massive amount of liquidity below, which means these levels are prone to being swept by the market or prone to falling victim to basically these stop hunts that we've just discussed. So when we have equal highs and equal lows, it's very common to see movements like this, where the market stop hunts and then continues in its true direction. Or if we only have equal lows, it will likely stop hunt before moving higher. If we only have equal highs, it will likely stop hunt before moving lower, right? So this becomes a problem if you are trading support and resistance. You're going to be stopped out a lot and it might be tricky for you to understand why. Now, after this video, obviously you understand a little bit more as to why this is happening, but you still want to make sure that you are cutting this out of your trading so that you're not falling victim to the stop hunts at these highs and these lows. There's another way that we can trade this as well with a confirmation focused approach where we enter at these levels. We're looking to make the stop losses, the majority of traders, the entry for our personal positions. And we're going to cover this soon, but I'm going to go a bit deeper into this first. So on top of that concept of liquidity that we've already covered, there are two other concepts you need to understand in order to not only avoid stop hunts, but also take advantage of them for good entries. They are supply and demand and imbalances or imbalance. So let's cover supply and demand first. Now, supply and demand is basically an alternative to support and resistance. So if we take a look at this chart, we have here a pretty clear area of support, right? An area where the market's bounced previous times before, an area where it's bouncing currently. This would be seen as a good place to buy from because it makes sense. There's been buying here before. Why would there not be buying here in the future? Okay. Now, supply and demand is basically an alternative approach to this, which in my opinion is a lot more grounded in logic. Supply and demand uses the areas of consolidation before large upward or downward moves in a market. So here we have what we call a demand zone. This is an area where large amounts of buying took place in the past. This area here. How do we know this? Because following this area, this demand zone, we had this large drive up. So when we see a consolidation or doji indecision phase, whatever you want to call it, a sideways piece of price action before the market drives away with strength, that becomes a demand zone. And the concept then is This has been seen as a discount price to buy from in the past. Think about it from a realistic auction-based scenario, right? If something was cheap but the price went up, you don't want to buy it at a higher price. But if the market comes back down, say it's houses, and it comes down to a reasonable level that was a good price before, you're more inclined to buy, right? So this demand zone just basically indicates an area where large buying took place before. We know that because there's a large push after the demand. So that theory would then suggest if the market price is able to come back down, this was seen as a good level to buy from before, so it likely will be again, okay? Now we can say the same thing about support and resistance, but we don't generally get such significant pushes from these areas of support and resistance, right? This is most notable by the point that support and resistance is a level that the market has tapped multiple times. Now, if buying was strong here, we may get one tap back in and then we would fly away. But because the market is literally just sitting in this area and the pushes that we're getting away aren't considerably strong, yes, it's an area where buying is taking place, but it is an area where buying is not taking place in any considerable quantity in comparison to when we see these large pushes away from demand zones. So demand is a little bit more logic based in my opinion. We're basically identifying the areas where institutional trading is entering a market, and then we are using those areas to take calculated buys again in the future. And the second concept we need to discuss is imbalance. So an imbalance is an open price range. Now here from this high down to this low, we have an open price range. It's this area here, right? So we got a big push away. The market hasn't yet filled it in. That is why it's an open price range, also known as an imbalance. If we look previous to this imbalance, to some of the price action beneath, just here, we can see that we don't have this same problem, right? So what we have is just here, we have this indecision candle indicated by a big wick below, a big wick above. So this would be our demand area. The market then pushed away with this candle here. So all of the imbalances in the market previous to the point that we're looking at here with this clear imbalance has now been filled, right? We have no imbalance previous. This is the only imbalance left in the market. So let me try neaten this up a little bit. This is our support. So we're looking at this from a support and resistance basis. That's not how we're going to be trading, but it's good to keep on that. Beneath the support, we have an imbalance, which is an open price range that hasn't been filled yet. And beneath the imbalance, we have a demand zone, which is an area where institutional buying took place before. Now, with these concepts in mind, we would now no longer be looking to buy a support retest because we know it doesn't make too much sense. There's imbalance, which is a range that is likely to be filled, kind of acts as a magnet for price. And there's a demand zone beneath, which is a discount price area that we know buying is likely to take place from again. So with these two factors in mind, we would anticipate that the market can drive lower, trade into this demand zone, and then get its push into new highs. Now, this is how we avoid stop hunts. Because if we think about where stop hunts may be taking place, well, if we were looking at this support and we were going to trade this, we may enter a position that looks something like this. If the market retests that support again, we want to buy, put our stop losses beneath the low, and trade higher. This creates that liquidity under this level that we've discussed. This liquidity acts as a magnet for price, trades us through the imbalance, and comes into the demand zone. So instead of taking an entry here, we would instead be looking to use the new imbalance and demand theory that we've used, as well as obviously the liquidity, because remember guys, under this support, we're going to have equal low liquidity, right? We're going to indicate liquidity with this little money marker. That just simply means that is a level where liquidity is. So there's a huge amount of stop losses and sell stops waiting under this level. We know that this support is not really an area of institutional buying because it's being tapped multiple times, showing the strength coming from this level is not great. We've got imbalance beneath, which we can indicate with a little arrow here. And then we've got an imbalanced demand zone beneath that, the demand being the area where the buying is likely to take place. So instead of a trade like this, we'd be looking to place an entry. We can do that in the form of a buy limit order. I'm going to explain a different way that you can get in as well in a moment. Stop losses would go underneath the zone, and then our targets would take us higher into wherever we wanted to go. Let's, for this trade example, just use the previous high. So this becomes a more viable position, and this will allow us to avoid the stop hunt problem that you have probably been running into. Because now we're trading with more logic, and we know that this area where you usually would have put your stop loss is instead going to be a point where the market is very, very likely to drive through. So let's run this market through. We can see here we have a market run down, taps into the demand zone, and following that tap into demand, we have a run back up and trade back into the next high. Now the market did continue moving from this point onwards, which allows us to take a larger position if we want to, but for explaining the theory, this is a super solid way to do that. Now obviously this is not all too difficult. You just want to identify 3 steps. First, you need to identify the trend. Then you need to find imbalanced demand zones. Then you want to consider the liquidity and make sure that you are trading from beneath the liquidity and not becoming a part of it. The liquidity just being the stop loss orders situated in here. You got to think about where the logical point for stops is going to be. When we've got a support, we know stops are below. When we have this imbalance in demand, we see that as a very, very clear run where the market's likely to trade through those levels and then hit that demand before rallying. So imbalance and demand and the concept of liquidity is going to help you to avoid these stop hunts in the future. And just so you know, you can do the exact same thing, but for a sell position. On a sell trade though, we just call this a supply zone. This is where supply is entering the market. So demand and supply is the same and works in exactly the same way, whether the market is moving down or up, in the same way that the liquidity and imbalances do, but we call this a supply zone instead of a demand zone, and then this would be equal high liquidity instead of equal low liquidity. Now, one thing I want to cover for you is confirmation, because maybe you're a bit scared of entering these trades with buy limits, because you think the market could potentially go lower. That's completely fine. That is also understandable. So now I want to show you fractal confirmation and how we can take advantage of that to take some good trades. So following this initial retest just here, where the initial buying would have taken place, if you didn't want to buy, you could use a concept that we call, or I call, the standard confirmation, right? This is where we use market structure, so we look at the highs and lows of price to identify shifts from lower lows and lower highs into higher highs and higher lows. So this market here, we can see from pretty much this high, started to create these lower lows and lower highs on a smaller time horizon. Now after that, we had a push up. The push up in price took us above this price level just here. So we had a break, pushing us over this high and creating this new high in the market. Now we can actually use the same concept again to take confirmed positions following on from what we've already seen. So at this point where we get this break of structure, we've confirmed the move. This is indeed valid down here. And now the market's confirmed that it's ready to go higher. So we can use market structure and we can use supply and demand and imbalances to actually find an entry for a position. What I'm going to do is just jump this market back to this point here. We can see after having the break above the structural point, we've got a small imbalance left open. The imbalance is really going to be this candle and then all the way through just really to that demand zone there. So we got a demand zone just here. How do we know this is demand? Well, this is a consolidation or indecision candle, which is basically indicated by large wicks either way and an open and a close price next to each other. And then we've got a push away, which is the imbalance. We've got demand, we've got imbalance. So we want to enter this position. And generally we want to kind of keep stops under lows. So we would ideally want to have it under here to be safe on this position. And then targets wise, we can just extend this to wherever. I'm going to leave it open-ended for now, just to show you the theory of the entry. So now we've got that standard confirmation. It's taken place, right? We've had pretty much a trade down from lower lows and lower highs. We had a push up. The market then formed a demand. And now we are looking to buy from the demand just here, right? So we're looking for a pullback and then a rally. That crossed over to the real chart is going to be that pullback and then rally, right? So this is pretty much just a safer way to get into the position, right? Because now we've got confirmation from structure agreeing with us. And yes, you get a later entry. Yes, your stop loss might be a bit larger, but it's a good way to get in if you have a low risk tolerance and you're a bit more averse to potentially being scared or hesitating by not getting into this trade because of the risk that you're taking. We have a trade confirmed now. We know the structure should be continuing to the upside, so we can trade it with a bit more confidence that it should indeed work in our favor. And that is a great example of a confirmation-based entry using imbalance, supply and demand, using structure, using market structure, so the trending direction, in line with that supply and demand and imbalance concept I just showed you. Now, what do we see after this formed? We actually formed another confirmation-focused entry. So if we take a look at this candle just here, which is the last candle before the impulse away, that's our demand zone. What do we have? We have demand, push away, imbalance created, new high formed in the market, which shows us the market's continuing bullish. So at that point, we could enter on the demand with a buy limit once again. We can have stop losses under the low, and then we can just extend our targets to wherever. And as you can see, this one would have worked as well. So this is just the more confirmed approach. You usually get multiple opportunities to take confirmed entries a bit later within the movement if you didn't want to take or you missed the initial entry. So that's just a nice extra tip. Not so much directly related to stop hunts, but a great way to get in and avoid stop hunts altogether because you're not getting in at highs or lows anymore. You're getting in during the trend. And if you always consider the imbalances and the supply and demand concept and the liquidity concept I've showed you today, you'll be able to avoid stop hunts as well as take advantage of them to get those great entries like the one we covered down here. So armed with your new knowledge, you should be able to avoid stop hunts, and not only that, but also use them to take some great entries for your trades. Now, if you want to learn how to build this into a system, hit the top link in the description to join my 7 Steps to Profitable Trades free course, where I teach you how to build a trading strategy and then validate it and trade it live profitably. And if you don't want to do that, then just check out this video next. That's going to teach you more about these liquidity concepts so that you can deepen your understanding and take better trades. So with that said, thank you for watching, and I'll see you in the next one.